Hey everybody, Tim Ulbrich here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, Tim Baker and I talk all about credit as an important thread of the financial plan. Specifically, we discuss why credit matters, how credit works, the makeup of a credit score and how to improve that score, common credit misperceptions, and strategies to protect your identity and secure your credit. Before we jump into the show, I recognize that many listeners may not already be aware that at YFP, we support pharmacists at every stage of their careers to take control of their finances, reach their financial goals, and build wealth through one-on-one, comprehensive, fee-only financial planning and tax planning. If you're ready to see how YFP can support you on your financial journey, you can book a free discovery call by visiting yourfinancialpharmacist.com. Whether or not our financial planning and tax services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. All right, let's jump into today's episode. Tim Baker, welcome back to the show.
Good to be back, Tim. How's it going?
It is going well. I'm excited for this discussion. I'm not sure most listeners are going to be. I think when they see something like credit, maybe like tax, they're like, whoa, blah,
Yeah.
not the most exciting thing to discuss, but I think it is especially true for those that are focused on more inspiring goals of the financial plan, right? Those that are focused on investing or making a large purchase, maybe paying down debt or giving goals that you're working towards achieving. Those are exciting, right? Credit, maybe like tax, not so much. But as we're hopefully going to lay the case out today, such an important thread and part of the financial plan that we want to make sure aware of, and we're optimizing the best that we can. So we're going to talk today about why credit matters, factors that impact your credit score. If we understand those, we can work to improve those. Some of the misperceptions around credit, and then how to protect your credit and how to protect your identity with credit. So, Tim, before we get any further, I think it's important that we check in with ourselves about debt and how we feel about debt, whether it be having debt, using debt. Everyone can feel different if we think about the spectrum of this. So tell us more about debt utilization and why this is important before we get into the discussion of optimizing credit.
Yeah. So if you look at the spectrum of debt, most people have probably heard of the term like good debt and bad debt. And I think like if you put all the types of debt out there, everyone's line is a little bit different, probably not too different. So if you think about like things like a mortgage debt. So, this is a note that you have on a home that you're living in. It's a use asset. Maybe you're
Mhm.
raising a family. Hopefully that home is appreciating over time. So you are paying interest on it. Most people would say, hey, pretty good debt. Things like if we go over kind of a notch, something like student loan debt, which I know is near and dear to a lot of our listeners. A lot of people still say, for the most part, student loan, you take out loans to be educated and trained for the opportunity to essentially out earn peers that don't necessarily have a college degree. You can argue there's probably a spectrum inside of that spectrum itself of like what's good student loan debt and bad student loan
Yep.
debt type of thing. But most people would say, hey, even today, most people would agree. The studies show that if you have a degree, you're going to earn more over the course of your career. So most people say good debt. When you get beyond that, that's where it kind of gets a little bit shady. So, the next one over is probably things like a car note, like an auto debt. The
Mhm.
problem with a car note is that you are paying interest on an asset that is depreciating the second that it pulls off the lot and every year thereafter. So it's still a use asset. It does the job of kind of getting you from A to B, hopefully, to work or just to live your daily life. But a lot of financial experts would say if you can go without financing a car, do that, right? Because of all the things that I mentioned. What I typically see the evolution of things, Tim, is like a lot of people, if they're a couple, a lot of them will see them early in their career. Maybe there's two car notes, and then maybe they transition to one, and then
Yeah.
towards the end of their career, we should be buying cars in cash. And I think it does, force the issue of like, do we really need an $80,000 car? Can we get by on a $30,000, $40,000 or whatever it is? Again, no hate on that if that's your bag. It's just it's just part of your plan. But most people, that's kind of where the line is drawn. Is like, okay, what kind of debt is that? Is that good, bad, or indifferent? So from there, you get into things like the cost of like furniture. A lot of people out
Mhm.
like, hey, I just moved, I need to, basically fit out my apartment. So I'm putting furniture on debt and I'm paying that off. Again, a lot of people say don't necessarily do that. And you have all the way out to, so, the purchases of wants and not necessarily needs, that's typically can fall on credit card debt, which can be super predatory if that can get out of control.
Hmm.
And, you have things like payday loans, which are, really, really bad. So that spectrum of sorts is kind of where kind of review. And I would have people look at their own debt that's on the books and say, hey, like, is this good, bad debt? And if it's bad debt, let's really, that's the bleeding headwind potentially of your financial plan. So let's really tend to that and triage that. If it's good debt, we're not going to, ignore it. We're going to have a plan for it. But we just know that it's more about the plan to pay off the debt versus paying off the debt, which,
Yeah.
make sure that we're doing for the bad debt. So that's kind of the spectrum in terms of how I look at debt and, how this can fit over, into the whole, credit discussion.
It's important we start there, right? Because credit by definition is we're taking on debt, right? And we'll talk about how that might be utilized. What are the risks? What are the upside? Potential leverage opportunities. How do you optimize credit? Where does it have an impact? But that is a step in the direction of taking on debt. Now, some people we'll talk about the different types in more detail. If you're paying off a card each and every month, like you might not look at that as necessarily taking on debt. But that's essentially what the bank is evaluating is what is
Yep.
your risk, what risk are you to the bank in terms of being able to pay off that debt? And that's going to depend on the terms that you're able to get. And I think, as we so often say, when we think about debt for our own financial plan, or I know our team's doing this when they're advising people, we've got to look at the math. We got to look at the different types of debt, and we've got to look at how someone feels about the debt. And we put all of that together when we're looking at debt as a part of the financial plan. And when you have two individuals, spouses, partners, significant others, coming together on the financial plan, especially if we have different feelings around debt, there has to be some discussion to be had there as well.
Yeah, for sure. I mean, there are some people, we take the student loans for example. There's some people that are like, this needs to go yesterday. Like, I have anxiety, it's a weight, blah blah blah. And there's some people that are like, meh,
Meh.
it is what it is, right?
Yeah.
And that emotion plays, right? So
Mhm.
I think now again, I think the way you can, like, if you're like meh for credit card debt, like, I think there's a realignment that we need to do, like,
Yeah.
because again, mathematically, if you're meh, you're gonna see that, talk to a prospective client that had $25,000 in credit card debt. You're going to see that if you have a meh attitude, that 25,000 is going to grow, balloon to 50 very, very
Right.
quickly. So I think it's important to understand that too.
So let's jump into our first part of the episode, why credit matters. And as we start this discussion, I think it's important we understand how credit works. And so, Tim, as a consumer, whether it be, a credit card purchase you're using, you swipe your card at the store, and then somehow, some way that ends up impacting our credit report, our credit score, as well as other types of debt. So take us through the credit cycle so we can understand how credit works.
Yeah, before I get into this, let me just talk about, like, kind of the legislation that kind of set us on this path of, like,
Yeah.
our credit system. So, or at least revised us. So back in 2003, the Fair and Accurate Credit Transaction Act, or FACT Act, was passed, that essentially allows free access to credit reports, and kind of what I'm describing here shortly, to every U.S. resident, at least one free credit report every 12 months from each of the three major credit reporting agencies, which is Equifax, Experian, and TransUnion. It also set up provisions to reduce identity theft, which we know continuously are becoming more and more of a thing, as we kind of transition to even more and more of a digital world. It requires, companies to securely dispose of your consumer information. That's a big thing for us as an RIA, oversight by the
Hmm.
SEC, and on the tax side, a tax firm, oversight by the SEC, like, or the IRS, I should say. It's a big deal, right? And the last thing it does is it doesn't necessarily require a lot of these companies to give you free credit scores, and we'll talk about the report versus the score.
Yep.
But they become more ubiquitous through, like, hey, you can get it through an app or your bank oftentimes. So a lot of that has been, less a B2C of, like, hey, Tim Baker's going to go buy my, see my credit score, where the places that I bank or do business with kind of do that
Hmm.
B2B, and then they do that as a benefit if I'm banking or doing whatever with them. So the fact that kind of, like, lays the groundwork. Essentially how this works, Tim, is you have you the consumer, you the borrower, and your behaviors kind of start this cycle. So you essentially, you'll go and you'll buy a car, or you'll swipe your credit card for groceries. Essentially, what's happening here is when I do that, I'm asking Mastercard or Toyota, a creditor, for credit to basically make these purchases because I don't have, or I don't want to spend the cash in that moment.
Yep.
The creditor, especially for something major like a car note or a mortgage, will say, okay, this person, do I want to grant them credit? So what they typically do is they look at those three reporting agencies that are there, that are basically the gatekeepers of the information of the behavior related to your ability to pay back your debts in full and on time. So those reporting agencies for all the different transactions, whether it's credit cards, whether it's another type of revolving debt, a student loan, a mortgage, whatever it is, collate all this information from these creditors and at the reporting agencies, and then they basically build out credit reports. So the credit report is kind of your report card with regard to your credit. So it'll show all the different, adverse accounts. So hopefully you don't have any of those. And then also accounts that are in good standing, that are
Mhm.
basically like, hey, we're doing what we're supposed to be doing. Now, it's hard in a snapshot world to say, okay, like I'm looking at a bunch of pages of a credit report. How do I actually, as a creditor, as someone that's going to lend this person money, how do I quantify their
Mhm.
ability to pay me back in a timely manner? And that's where we get the credit score. So the credit score basically distills down your ability to pay back the money that you owe. And then that credit score then feeds back to you, where you say, okay, hey, I have a 750 or an 800 credit score. So then I then take that back to the credit card and say,
Mhm.
like, see, this is like, I'm good, or like, maybe I'm not so good. And then that affects, again, that whole cycle. So that's essentially how it works, in terms of like how credit is tracked and reported and then quantified for you, the consumer.
That's a great summary, Tim, because I think as we'll talk about improving your credit score here in a little bit. If you understand your credit report and you're checking your credit report, I know this is something you said on the show before, like, hey, mark your calendar once a year. Maybe it's when the clocks change, whatever, where you're pulling your report, right? You mentioned the three agencies, Equifax, Experian, TransUnion. And when you start to dig into those reports, you'll understand the different variables of which are being aggregated up and reported on to the credit score, which will then help you understand, oh, well, maybe I can increase this or improve this or do this differently to drive up my credit score, which then has an impact on the different parts of the financial plan. So all connected, great description. And why does credit matter, right? I want to make sure we don't brush by that obvious but important question. We've all probably been told at some point in our lives by a parent or an advisor or someone, like, you got to build credit, you got to have credit, you got to have a good credit history. What's the so what why is this so important?
Yeah, so I think like if you kind of look at some of the things that credit affects, it's kind of your ability to get credit and like what you pay on that debt. So interest rates. So lenders use your credit score and history to determine whether to approve a loan or to give you preferable or less than preferable rates. And this affects mortgage or auto, personal loans. So good credit score usually gets the lower interest rates, that which saves you
Mhm.
money over time, which could be huge when you talk about, a two, three, four, 500, $600,000 purchase when we talk about a home. Um, renting a home, a lot of landlords check credit reports to assess whether potential tenants are financially responsible. We do this with our tenants.
Mhm.
It's a one of the things we that a lot of landlords will do to make sure that, hey, is this person going to actually, like, they're going to sign the dotted line and say they're going to, pay this rent, like, are they actually going to do it? um, Insurance premiums, in some cases insurance companies use credit information to set premiums, particularly on auto insurance. Again, it's
Mhm.
kind of a measure of reliability. Even employment, some employers check reports as a part of their hiring process for, especially if it's related, to finances or sensitive information. So poor credit can negatively affect your job prospects. I think it's also tied to utility services. So utility companies, think electric, water, internet, may check your credit when you sign up for a service. So they could actually require a deposit or even deny services. if you're obviously if you're applying for credit cards, you're going to get the best rates and higher limits if you have better credit, maybe even better rewards. And then, just good like financial flexibility, right? A good credit history gives you more options for borrowing and managing your finances during emergencies or making
Yeah.
major purchases. Now, some of those are going to be systemic, and we talk about this with business owners. Like now is the time to get a line of credit, right? Because once the market changes or the economy, we go through a recession, that's when, a lot of credit freezes. So you want to establish good behavior and be able to access credit when things are good, not when things are bad, right? It goes back to planning. So that's really the so what, Tim, of like why it's important. And,
Yeah.
and, and it is, I think it is becoming more of a measure of overall reliability that is, again, it's very much for your finances, but I think that's a good indicator of your overall reliability in general. So that's the so what.
And that's why I used the word threat earlier, right?
Yeah.
Look at the list of examples you just gave of where this can impact the plan. And I think the one that people are often thinking about is like, oh, if I go to buy a home, very practical. If my credit score is X versus Y and X is better than Y, then I'm probably going to get a more favorable, rate on my loan or, buying a car purchase. But I think
Yep.
there's some other ones that you're alluding to when you talk about like line of credit on the business side. Having good credit puts you in a position to take calculated risks in the form of leverage and to do so at the lowest cost possible. Now, calculated risk, right? There's always going to be risk involved and there can be a downside to that as well. But fair or not, I mean, that's really the system that we live in. And our financial systems are rewarding those who can take on and pay off their credit. And so, starting a business, investing in a business, buying real estate, beyond your primary, all these things are going to require, unless you're bringing cash, they're going to require you to have your credit evaluated.
That's right. That's right. Yep.
All right. Second part is understanding and improving your credit score. And there are several factors, Tim, that go into the credit score. And I think as we understand each one of these, we can begin to then think about the strategies to improve our score over time. Maybe some of our listeners have great credit and it's keep doing what you're doing. Others, maybe, because of a final year of pharmacy school, residency, other things, they had missed payments and other types of debt that accrued. Maybe there's some repair of credit that needs to go on. So take us through the main factors as it relates to the makeup of a credit score, and especially those that have some of those higher impact factors.
Yeah. So, and when I first started learning about credit back in the day, Tim, like a lot of the information that I researched, and got, like Credit Karma was a great resource for me. And if you actually, and again, not a commercial for them, but I personally use Credit Karma. A lot of their things checked out. That's where I can get like a free. It's not free. They're selling my information, and every time I go on their app, they're like, "Hey, this is a great credit card." So like, there is a price for it, but like I was skeptical at first. I'm like, hey, is this really legit? And then I, actually purchased the TransUnion credit score, and everything kind of like matched out, right? But I think they do a good job. It's a great resource to kind of
Mm-hmm.
um, understand at a very high level, like how this works. So if we talk about the factors of a credit score, the where the rubber meets the road, probably the highest impact factor is payment history. And from what I understand, it makes about 35% of your score. This is the most predictive factor in determining whether a borrower will repay debt, as a history of on-time payments indicate lower risk for lenders. So if you are missing payments, then you're gonna, your score is gonna get hurt, which is gonna, affect all those other things that we talked about. So
Mm-hmm.
can you pay your bills on time? And on time is actually flexible. So like, once you go 30 days beyond like a due date, that's when you typically get hit. So like if my credit card bill is due on October 15th and I miss that payment and then I don't pay it by November, if I pay it by November 1st, I'm still good. It's still on time for the credit reporting agencies. Once I get to that November 15th date, then that's where I get dinged. So that's kind of where the rubber meets the road, and everything else around this is important, but it's not as important as, are you paying what's the history? Are you paying it back on time? The other high impact factor, which makes up about 30%, is called credit card utilization. I've also seen it called like, what's the amount that you owe, amounts
Yep.
owed. So this is the amount of debt you carry, especially as a percentage of your total credit uh, line, your limit.
Mm-hmm.
So this is credit utilization, and it's highly correlated with risk. So in this case, what lenders like to see is it's the lower your utilization, the better. So they like to say, hey, you have available credit to you, you're just not using it. So anything that is basically 10% or below, it's typically excellent, right? So if I have a $10,000 limit on my credit card, let's say I have a five and a five, I have two cards. If I'm carrying anything more, carrying meaning like I don't pay it off at the statement balance. If I'm carrying um, $2,000, then my credit utilization is 20%, and it's still good, but it's not excellent. So lenders like to see you have the ability to use it, but then they want you to pay it back in a timely
Mm-hmm.
way. So the big thing here is to keep the balances low. Um, the next one, Tim, and these last really three or so are more medium and low impact. So the next one is age of credit, or like the length of credit history. So makes sense, right? The longer, if this is not your first rodeo, the
Right.
longer that you've been using credit successfully, it's a little bit of like again, your parents have been doing this for a while. If you're just out of college or you're just in college, you don't necessarily have the wherewithal to like understand how it works. So typically the higher is better. So they want excellent means you've had accounts open for 9+ years, and this is on average. So lenders like to see that you have experience using credit. Um, the next one is the total accounts, which makes up about 10%. You can also think of this as like credit mix. So managing a variety of credit types, whether it's credit cards, auto loans, student loans, mortgages, suggest a responsible borrower that can handle different forms of credit. So the idea here is they want you to be able to do a little bit of a lot of different types of credit, right? So they want you to say, okay, we have fixed, we have revolve, and that type of thing. The big thing here that I thought that was kind of counterintuitive is that the higher the number of accounts, the better. I would think like, man, if I only had one or two, that would be a lot better from an agency perspective or for a lender perspective than if I had like 20. But what we have to remember is that your your accounts stay under report for 10 years if they're good. If it's negative, it stays on for 7 years. So think about the last 10 years of all the different
Right.
things that you've done credit wise. That's what they're counting. For a lot of pharmacists, they get a number, they get another account with every um student loan
Student
disbursement.
loans. Yeah.
So for a lot of us, like when we're looking at a client's credit report, particularly when we're looking at student loans, it's several pages longer than most people just because of the student loan burden. And the last thing that's there is the hard inquiries, or like the new credits part of
Mm-hmm.
the score, and that's also 10%. So that's where what lenders don't like to see is they want the lower the amount the better. So what they want to see, they don't want you basically going around town, proverbially going around town, like inquiring on additional lines of credit. So this results when you apply for credit. So if I go to buy a car and I'm buying it through Ford, they're going to run my credit. That's a hard
Yeah.
inquiry. Or if I'm getting a mortgage, or if I'm moving and I'm renting a place, they might run a credit on there, and then the utility. So they really like hard inquiries to be excellent is 0 to 1, good is 1 to 2, and anything above that is fair. I can tell you, Tim, I have a crap ton of hard inquiries just because of the things that we've done over the years. That those typically fall off after 2 years, but I think what they're trying to do again is they're trying to look at, okay, how much is this person actively accessing new credit. Now I believe that, I don't know if it's a week or 2 week, but say like I go and I apply for credit at Ford, Toyota, Tesla, they'll group those hard inquiries into one if it's within like a 1 or 2. So they don't ding you on multiple. I would say though, like you probably shouldn't apply for credit for all of those. But that's what happens with those. So those are the kind of the big factors that kind of play a part into your credit score. um yeah.
Great stuff. Quick summary. You mentioned 5 factors: payment history, credit utilization. Those together more than 60%. So those are 2 big ones we want to pay attention to. The other 3 that are medium to low impact: age of credit history, total accounts, hard inquiries. I'm glad you mentioned the student loan piece, right? Because one of the things I'll often hear from new graduates that are learning about credit and trying to improve their credit, they're like, oh, well, I haven't had a credit card for that long. And they might only be thinking in that bucket, right? But if you have student loans, like you have multiple accounts on your
Yep.
credit report, and you're going to start to establish the credit history as you pay those off. Or you mentioned
Yep.
car notes, credit cards. Obviously, there are other things there as well. Again, Tim, if we start to understand these, especially if I just focus on the first 2 for a moment: payment history, so on time payments, and then credit utilization, so the percentage of credit available that we're actually using month to month. If we understand those and the large impact they have on our credit score, we can really start to lean into strategies to address those if they're an issue, right? So I think about things like automatic payments, auto bill pay. Is that a
Yes.
strategy? With
Yes.
credit utilization, I know I've gone back about once a year ish, maybe every 18, 24 months to say, hey, by the way, can we increase our credit limit? So asking for increases in credit limit, now understanding that might have and count as a hard inquiry, but asking for an increase in credit limit is then going to obviously drive down your utilization rate unless your spending's going up, at the same time.
Correct.
So these are some common things that we can think about: auto bill pay, asking for increases in credit limit if it makes sense, that can be favorable to our credit score.
Yeah, another thing you could do, like again, if there's parents out there of like kids that are starting to drive. I remember working with a pharmacist that I looked at their credit. I don't know, they were probably born in like 1990, but their credit history stemmed back to like 1976. And I'm like, how is that possible? But their parents put them on like a Sunoco gas card. So that kind of gave them an advantage,
Mm,
early on where, typically younger people have, less than ideal credit scores. And as you get older, almost by osmosis, you figure things out, and your account age, things like that. You have more of a history. But that was, that's a hack. You mentioned like if I'm in a good credit band, and maybe I should go through those, Tim, but like a good credit band, for scores is anything excellent is anything 750 or above.
yeah.
So and I'm using FICO. FICO's, I think 90% of lenders use FICO. Vantage is another one that's kind of come onto the scene. I think is used as well. I think they're similar in this regard. But the score ranges anywhere from 300 to 850. Anything above 750 is excellent. 700 to 749 is good. Fair credit is 650 to 699. Poor credit is 600 to 649, and anything lower than 600 is bad. Now the
Mhm.
average, when I look back at this in like 2018, I think the average scores was maybe like 693. In October 2023, when I looked at this, it was like 717, which is interesting because balances for credit, credit cards for Americans are at all time high.
Yep.
Um, I know they're trying to look at more like trended data. So like if your balances are trending down versus like a snapshot. But I think it's also important to know for people like what's not used to calculate credit scores: age, sex, religion, race, marital status, zip code. If you've ever disputed things on a credit report, employment history, occupation, and salary. So they don't care if you make 200,000 or $2 million a year. It's more about, again, your ability to pay. So we talk about this with the financial, income is not a financial plan. Income is not a good credit score. Sometimes people play like, oh, I make $300,000, my score should be great. They're not tied together. So I think it's important to kind of understand that too, is like what's not counted, and
Mhm.
how does that play a factor.
Yeah, and those may become a factor. I'm thinking about the impact, the income specifically, right? If you're buying a home, obviously they're looking at your credit score, but they're looking at your debt to income ratio in
Yep,
addition to the credit score as
that's right.
well. So, all right, let's shift gears and talk about top credit misperceptions. You gave an example of if you're buying a car through Ford financing, and you go through that application, that's a hard inquiry, right? That might have a short term negative impact on your credit. Which leads me, I think, to one of the common misperceptions that people confuse, which is your credit score drops if you check your credit. So very, very different thing that we're talking about here: applying for credit versus checking your credit score. So that's one of the most common misperceptions I hear is, hey, if I check my credit, it's going to impact my credit score negatively. What other common misperceptions, Tim, are you typically hearing around credit?
One of the big ones is like Oh, like I've had this account. I've had this Abercrombie and Fitch credit card since, I was in, high school. Like, should I close this account because this will improve my credit score? The answer is probably not, because that'll actually ding you on your, age of credit. So,
Mhm.
and I had one recently where my age of credit was really good, and I decided to. I had an old car. It wasn't Abercrombie. It was something else. But I had this old car and I wasn't using, and I'm like, I'm just going to close it. I don't have any credit decisions, and I closed it, and my age of credit took a hit. So that's one of the things. Once you pay off an account with a derogatory mark, it's removed from your credit report. So a lot of people are like, man, I missed a payment. I got dinged. I have a 30-day lateness. Let me pay it in full, and that's going to basically go away. Unfortunately, no. And I always talk about this
Mhm.
when I talk. There was a time where I had this. I ran my credit report, and in May of 2010, I had a 30-day pass, which I don't know what happened there, and that stays on my credit report for 7 years. So it fell off in 2017. Um, but that was something that a lender could say, not so good. And I think what happens too is, like, some people, when they when maybe they're spiraling, or they're like, oh, I missed it. They're like, they kind of put their head in the sand, and they're like, ah, it is what it is. I'm not going to. But
Yeah.
like, those things cascade, right? So, if you have a derogatory mark, like, that's fine, but like, stem the bleed in, right? You don't want to go
Mhm.
into a 60-day and 90-day to where you end up in collections. And I talked to pharmacists that this happens, right? And like, to me, it's like, all right, like, that's in the past. Let's move forward. So, but that will stay on your record, on your credit report, for 7 years. Another one I hear is like, hey, if I co-sign, will that make me responsible for the account? That's exactly what they do. Um, so be wary when cousin Fred or brother Paul or someone else says, "Hey, can you co-sign this?" Because you're essentially, from the lender perspective, they're not putting all of their eggs in brother Paul's or cousin Fred's baskets. It's now in your basket as well. So they look at this as a less risky. But if your co-signer acts a fool and kind of things go awry, you are on the hook for that. And where
Mhm.
we see this the most often is like parents co-sign in student loans, right? So you want to make sure that you're on your best behavior, so you don't necessarily affect your co-signer's credit, and vice versa. You want to make sure that if you're co-signing for someone, they're on their best behavior, so it doesn't affect your credit. And probably the last thing I've heard is like, oh, if I pay off this debt, will it add? I'm buying a house. Will it add 50 to 50, 100, 150? It doesn't necessarily work like that.
Yeah.
It's not a binary thing. It could help if it drops your utilization, but it's not necessarily like a dollar for dollar. It's going to increase your points, so to speak. So those are some of the misconceptions I hear. And the one that you brought up about, like, hey, if I check myself, like, I don't want to check it because I don't want to, like, affect
Yeah.
it. If you're applying and it's hard, but even that, it's 10%. It's not going to affect it that much. The big drivers are you paying your bills on time,
Mhm.
and, like, are you using a fraction of the credit that's available to you? Those are going to be the big drivers of this.
So Tim, let's wrap up by talking about credit security and specifically the difference between a credit freeze and a credit lock. I think these terms get thrown around a lot, perhaps interchangeably sometimes.
Yeah, so broad strokes, like, when you think about your credit, like, before we get to the lock and the freeze, like, you want to monitor your credit report regularly. Like, so, typically, if the clocks spring forward, they fall back. I think that's a great time to do it.
Mhm.
Admittedly, Tim, it's been a while since I checked mine. I actually looked at all three of them recently because I just wanted to see how they've changed over the years. And admittedly, I hadn't run it. I probably ran it over the pandemic, because during the pandemic, they're like, you can check it every month if you want. Um, so I think monitoring is a good safeguard. I think that using strong passwords and enabling things like
Mhm.
2FA, two-factor authentication will prevent some nefarious activity if people are trying to apply for credit in your name. So I think that's a good thing. Setting fraud alerts. A lot of, like,
Mhm.
you know banks now, they'll say, like, hey, we just saw hey, Tim, did you buy that bottle of whiskey in Louisville because you live in Columbus? And I'm
Confirmed.
like, yes, I did. Okay, get off my back. So but a lot, I'll get an email from Credit Karma that says like, "Hey, this happened. Is that is that real?" Or a bank. So credit cards do this too. So you want to be so if you can set fraud alerts, that's good. Be cautious about sharing your personal information. Shred documents. So like if you have documents that you get in the mail that have like account numbers or social securities, don't just put that in the trash can. Like people take that and mine that data. So I think it's important you want to review bank statements, credit card statements from time to time just to make sure that those are good to go. When we talk about the freeze is probably the thing, right? I'm not a big, like when I think of a freeze and a lock, the freeze is I believe it's legislated by Congress that you have to have the ability to freeze your credit, which means basically no one can access your like if you can authorize someone to pull your credit, but if you've already frozen it, then like you actually have to unfreeze it before you do that. So
Mhm.
I did that. I forgot about it. They're like, "Hey, we're gonna pull your credit." I'm like, "Cool," and they're like, "We can't pull your credit. You have to unfreeze it." So I had to, and it probably takes about 10 or 15 minutes on each end. So it's kind of like you put in your identity, give a blood sample. No, I'm kidding. Give a launch code, but
Yeah.
it's pretty onerous to kind of be able to freeze it and unfreeze it. So probably like 10 minutes on either side. If you are not making any type of like credit granting decisions or applying for credit, freezing your credit as a normal part of your overall process should be you should have frozen credit at all times. It can be a little bit of a pain, but if you're not doing those things, freeze it. The big difference between a freeze and a lock, as I understand it, is that locks are typically paid services by Equifax, Experian,
Yeah.
TransUnion that are like, hey, for this extra fee per month, we can lock your credit and maybe you get a little bit more features. So I'm almost like, I'm good with the freeze, and that's what I typically do. So I would say again, if you are not actively using credit, you want to have your credit frozen and then open it when you do have that, because Tim, it's really not a matter of, unfortunately, and I said this to a group of fellows the other day. They're like, "What?" And I'm like, "It's true. It's not a question of if your identity and some of your information is going to get stolen. It's when, in
Yeah.
my opinion, because you have bad actors that can make a lot of money with your information. So the more that you can do to proactively safeguard sensitive information and your credit is one of the better, because I just think that
Mhm.
it's always this cat and mouse game of like, all right, well, we do two factor. What's the how can we get around that, right? So I think the more that you do to safeguard your identity, your credit, the better. And I think a credit freeze is something that, and again, you can go on each of the reporting agencies and say, and they'll walk you through how you can freeze and
Mhm.
unfreeze it. And yeah, another one I meant to mention, although I think one of them was hacked, was like using a password, like a LastPass or a one
One
password, things
pass.
like
Mhm.
that. I think LastPass was hacked, but those are better than if you're the pharmacist that's listening out there that has a note on their phone that has their passwords. Again, guilty as charged in the past, long ago, but you want to have a password vault, so
Mhm.
to speak, that you're using you know that is you're using 12 plus characters and that type of thing. So yeah.
Mike, our IT guy, would be so proud, Tim. Like
Yeah,
your
kudos to
tech.
me. Yep, exactly.
Great stuff. We covered a lot. We talked about why credit matters as a part of the financial plan, how to understand and improve your credit score. We discussed some of the common misperceptions around credit and credit security as well. So our hope is to have this episode be one that we can link back to in the future. So as always, if you have some thoughts, ideas, topics you'd like to see, reach out to us, info@yourfinancialpharmacist.com. You can also go to yourfinancialpharmacist.com/ask, record a question, let us know your thoughts. I want to also put a plug. Next week, our episode a week from today is going to be a special one. We're bringing Joe Baker onto the show to talk about living and leaving a legacy. Joe Baker, many of you know that name. He's the author of Baker's Dirty Dozen, Principles for Financial Independence. Just a great individual, someone who's a huge advocate for financial wellness, financial education in the profession of pharmacy, and who is very, very philanthropic in his own right. And so we're going to talk about why is giving an important part of his financial plan, and what are some of the areas of focus that he has had as he's looking at making an impact today, leaving a legacy for tomorrow. So thank you so much, everyone, for listening. Have a great rest of your week, and we'll catch you again next week. Take care. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.